I think you have to look at gold over the next 3 to 5 years. There will come a point when it's too high. I mean, when gold corrects, it really corrects. So you have to, when its time is over, then you have to think about it. But you have to look at geopolitics today, and now it's going opposite direction. Most people would say when the dollar goes up, interest rates tick up a little bit, then gold goes down. But see, they're correlated. The dollar's going up and gold's going up. And so, it's got them confused. But I think it has to do with central governments. And they're just saying, hey, you know what? We're not buying the dollar. We'll buy some of it, but we're not going to hold the bonds. We're just going to buy the gold.
Gold's rally is raising a critical question. Are we witnessing the start of a powerful second leg higher or just a temporary surge before a correction? Ted Oakley, a seasoned market strategist and investor, noticed that gold has already delivered strong profits. The real question is whether it is entering the second leg of a major bull market, like the surge seen in the mid-1970s before peaking in 1980. Even with the possibility of 15% corrections along the way, the longer-term trend, in his view, still points to higher highs. For investors, that means selling too early could prove costly over the next several years. Adding to this, he pointed out the unusual situation of both gold and the dollar rising together, a shift he attributes to central banks reducing U.S. bond exposure and channeling more reserves into gold, a dynamic that challenges the old playbook. He also noticed that institutional flows into gold and miners remain far weaker than expected even with strong sector performance. That underinvestment, he argued, leaves plenty of upside if broader participation eventually arrives. Oakley emphasized that even if gold corrected from $4,000 to $3,000, miners would still maintain healthy margins of around $1,400 per ounce. This resilience, he said, makes the sector far stronger than many give it credit for. Oakley pointed out that the industry's average production cost is currently about $1,600 per ounce, a figure that highlights just how profitable miners are in today's environment. If valuations returned to the same price-to-cash flow multiples seen in 2011, these companies would be trading at nearly double their current levels. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
Gold and the miners for a long time, so it's nothing new to us. And we've got, obviously big profits in it. We haven't taken really much of it off, but here's a big question, and you'll never know exactly answer this, but are you in a second leg of a market that's going to go a lot higher? I'm talking about gold. As you go back and look at 75 or 76 in gold, all the way up for the peak in January of 1980, it was a big move. I mean, it was a 6, 7, 8 fold move, and then it corrected big. If you take our low of, 1,500, whatever it was at the low, and you put on 4,000, that's not 6 times. And I'm not saying we're going to 9,000 either, but it's hard to say whether that goes on. Now, you could get a correction, I think, anytime of 15% or something. And I know people would think it's over, I'm going to sell out, but probably more than likely, even if you got that, later on, over the next 5, 6, 7 years, you go to higher highs, and you'll probably be sorry that you sold it. But it wouldn't surprise me to get it. But either one wouldn't surprise me. It wouldn't surprise me to go on up from here, because obviously it turned real parabolic. And now you're starting to see the articles in the paper, on CNBC and Bloomberg, when they start talking about it. But I will tell you this, though, it's way under-owned. If you go look at, for example, the GDX, which is the large gold miners, they've actually had money flowed out of the system in this year. In other words, they go up, but people take the money out. And as a percentage of assets, you look at even today where the gold miners are, they're nothing as a percentage of the market compared to any other group. So there's a lot of room to run there. I know they've had big moves, but I don't think you can always say, well, it's over now. I don't know if it's over or not. I don't think it is, but even if we got some selling, it wouldn't make us clear out. We would, I'm not saying we wouldn't take some profits maybe here or there, but generally, I think you have to look at gold over the next 3 to 5 years. There will come a point when it's too high. I mean, when gold corrects, it really corrects. So you have to, when its time is over, then you have to think about it. But you have to look at geopolitics today, and now it's going opposite direction. Most people would say when the dollar goes up, interest rates tick up a little bit, then gold goes down. But see, they're correlated. The dollar's going up and gold's going up. And so, it's got them confused. But I think it has to do with central governments, and they're just saying, hey, you know what? We're not buying the dollar. We'll buy some of it, but we're not going to hold the bonds. We're just going to buy the gold. Well, the industry has a group, so they know what the cost of production is. It's about $1,600 now an ounce. And so if you look at that relative to price today, then you have to factor that into these gold miners, and because they're super profitable. Now, if they sold at the same price to cash flow multiples today that they did in 2011, and I may be off on this some, but they're probably twice as high as they are right now, because they've gotten a big push. I know they've gone up, but they have not gotten the buying from the institutional people that you think. And if the price stays up here or goes higher, they're just going to make more money. Even if it fell off, if say gold fell back from 4,000 to 3,000, they're still making $1,400 an ounce. I mean, it's not like it's not a good business. So people have to keep that in mind. What's your cost of production? And that's where we are right now. It depends on what you're doing. I mean, we have 3 portfolios, and I'll give you an example. In the stock portfolio, if we can't find stocks that fit our criteria to buy, then we hold those in, 90-day and 180-day treasuries. And so we've got about 40% of that portfolio in treasuries right now. I'm not trying to time the market, but it shows you how expensive the stocks are right now. So to get a really good value, you have to be real picky about what you buy. And you can't continue buying this unprofitable stuff and all this crazy stuff they do. So that's how we use the treasury. We don't think about it as an allocation at all. If the prices were cheap tomorrow, even in our high income portfolio, which we have probably 50% treasuries, only because we don't have the things we want to own. And by the way, they've all done really well, believe it or not, because we had the right allocation. Well, we had the right stocks and income miners we wanted to own. They've done well. And you can do well and have a fairly high allocation to treasury. But if things got really, really cheap, we wouldn't have any allocation to treasury. We would be 5%, and it all has to do with prices and what the valuations are. So that's what I was saying is we don't have that thing where you say, well, we're 60-40 or 60, whatever you say, 60-20-20. We buy them when they're cheap, and that's how we allocate.
Ted Oakley pointed out that the Federal Reserve continues to misread the landscape, with inflation still near 3% and yet a willingness to cut rates for political or short-term reasons. He noticed that such moves risk fueling speculation and reigniting inflation, which he views as the most damaging force for the working class. In his view, inflation acts like a stealth tax, eroding the ability of ordinary families to make ends meet as wages fail to keep pace with rising costs for essentials like food, energy, and housing. This disconnect, he warned, is often ignored on Wall Street, but ultimately pushes the economy toward instability. He further noted that the bond market is signaling caution, with the 30-year bond remaining largely steady for months, suggesting long-term buyers see no justification for aggressive policy shifts. Oakley emphasized that the most prudent course for the Fed would be to simply do nothing, holding the line instead of folding to political pressure. By chasing short-term fixes, he argued the Fed risks repeating the mistakes of the past, setting up conditions that could once again spiral into deeper economic trouble. Let's get back to the interview.
Well, one thing for sure, they don't know what they're doing. I've watched the Fed my entire career, so they're going to be late or not doing the right thing. And the problem with lowering rates right now is that we really shouldn't be lowering rates. I mean, you have 3% inflation, and you can say, well, I'm going to forego inflation for unemployment. But what they don't realize is that the most detrimental thing you can do to an economy and the working class is to have inflation. So and they sound like they want to lower once or twice before year end. Let's say you do that. Okay, but you're going to be reinflating again by the end of the first quarter and second quarter. They're going to have to come back and say, gosh, all this money is inconsistency. Everybody keeps on speculating again. And we've got a Federal Reserve that's brain dead to what they should be doing. And right now they're folding politically. So, and it looks like they're going to fold politically because they're going to stack the deck. And it'll be like the 70s under Arthur Burns, where they keep trying to lower the rates to get things going, but it kicks the inflation rate back up. They got to come back, and finally it gets so bad that somebody like Volcker came in and said, I'm going to fix it, but you're not going to like the way I do it. I think it is, because inflation is a stealth tax. In other words, if you look at what affects the average family that just barely gets by, it's inflation. See, that's what they don't know on Wall Street. If my groceries are going up, my electricity is going up, a la data centers, and my car payments, everything's going up because we're having to charge more for everything, then I can't make it to the next month because I'm not getting that kind of raise, you see. And they forget about that. And that's what puts pressure. And that's what brings you into these periods where you throw your economy into a tailspin. Well, I don't know that I would be right either, but what I would be doing right now is nothing. I don't think there's any reason. And in the long 30-year bond's telling you that. The 30-year bond hasn't changed much at all in 6 months. And it's basically saying it was a little bit, but not much. And I think those buyers are saying, hey, you know what? You people got it all wrong. You can lower the short-term rates and try to juice the economy and that sort of thing, but you're going to give it up on the inflation side. And so if I were the Fed, I would do nothing. I just go just like we are. And, that's not going to happen politically, because obviously you can see what's going to happen. They're going to stack the deck here with the people on the board, and they've already succumbed to it. So I don't think I don't think you should dollar cost debt. No, not at all. I think you ought to keep your debt close in, because you've got to be able to define debt is your safety valve. Well, if you've got 25 and 30-year paper and it goes down 25 or 30%, it's not a safety valve anymore. It's a cost, okay? And you're going to worry about that. You should have a bond portfolio, treasuries or whatever you want to use. We use treasuries. That's short enough so that if anything goes wrong, that is very, very safe. And you can use that to your advantage to either buy things that are really cheap, sleep well at night, make sure you're okay. But you can't just throw in a bunch of things and say, I'm going to be better 20 years from now, because I could give you the statistics on it. Go back to 1900, and the markets go through numerous 20 and 30-year periods where they make zero money, nothing. We've forgotten about it now in the last 20 years in this country, but I'm telling you, it happens. And you have to be in a position where you can weather any storm that comes your way, sleep at night, and know you're not going to lose everything. And the problem about most people is they put it in there and things fine, they make some money, and then they come along and they get a big setback, and emotionally they're not ready for it. So they sell out at the worst time.
Gold and miners remain positioned for long-term strength, supported by strong margins and underinvestment from institutions, while central banks continue shifting reserves away from bonds and into hard assets. At the same time, policy missteps risk reigniting inflation, which functions as a hidden tax on households and erodes economic stability. In such conditions, maintaining shorter-term, safer debt provides flexibility and protection, ensuring investors can endure setbacks without being forced into emotional decisions at the worst possible time. How can investors balance the opportunities in gold with the risks of inflation and policy missteps? So stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.